Good afternoon and welcome to St. Joseph's University's Unlimited Learning Expert Series. I'm Dr. Karen Hogan. Some of you may know me as Professor of Finance and the Brian Dupereau Endowed Chair in Risk Management and Insurance. I'm joined today by our other expert and my better half, Paul Hogan. Paul is a Managing Director at Debt Capital Markets at M&T Bank, and we are proud parents of two St. Joseph's graduates from the classes of 2016 and 2022.
Thanks, Karen. Pleasure to be here. And thank you all for taking the time to join us today on what is a timely topic. I did want to mention that in addition to having two of our children attend St. Joe's, and Karen obviously working there, my father attended, two of my brothers attended, and I have several close friends and colleagues who attended St. Joe's. So really happy to be here talking to the alum. Before we get into the main topic, talking about what happened to Silicon Valley Bank and what's going on in the banking sector right now, I thought I would just give a brief overview of my background, what I do, how I do it, and how the banking system works to a certain extent. And then we can kind of dig in a little bit more detail into Silicon Valley. So I've been in banking for 30 years. The entire time I've been in debt capital markets. And what that means in the banking industry is banks buy and sell loans from other banks. So I started my career at a bank in Philadelphia, Core States. Once that was acquired by First Union, I joined PNC. I was there for quite a while. And then about 5 years ago, I joined M&T Bank. And so given M&T Bank's based in Buffalo, we don't have a large deposit base. We don't have a lot of branches here in Philadelphia. So I thought I'd just give a little bit of context about M&T Bank, how big we are. We're about a $200 billion institution. Where does that rank us? In the top 50 banks in the US, we're right in the middle. We're number 22. So just to give you some context, JP Morgan has $3.9 trillion in total assets. The 50th largest bank in the country is the Bank of Oklahoma, which has 45 billion in assets. So we're at 200 billion. So again, right in the middle. And I think that gives you a little bit of perspective of how fragmented banking still is. We're about 4,000 institutions in the US right now, which is down significantly. I think the peak was about 20,000, but it's very, very granular. And I think you see how quickly the size falls off once you get beyond the 50th largest bank at 45 billion. There's just hundreds and hundreds of community and state-run banks in addition to the savings and loans and savings banks.
Okay, Paul, just before we get into Silicon Valley Bank, I wanted to just take a minute to thank St. Joseph's University for coordinating today's event and to thank all of you for taking the time out of your day to attend. So a key element of the St. Joseph's University mission is the commitment to lifelong learning. And that mission has led to the creation of the Unlimited Learning Expert Series and today's interactive discussion on the banking crisis. Over the next hour, we will be discussing how turmoil in the global banking industry unfolded over the past 3 months and whether this critical situation is coming to an end. Later on, we'll address some of your questions that you submit in the registration and also during the webinar if you put any in. So if you have any questions during the course of the webinar, which I'm sure some of you will, you can use that Q&A feature below on your screen. Please, if you're doing so, include your name, your location, your graduation year, if you're an alum, so that we can give you a shout out. All right, so Paul, I know you're excited to talk about
I jumped the gun. Sorry about that.
So let's start off by setting the stage a bit. Can you, with all of your expert knowledge, provide us with some background on what led to the collapse of Silicon Valley Bank in March, and also the domino effect that was created by other institutions?
Sure. Maybe before we talk about Silicon Valley, I'll just give a quick overview of the banking model. And it's very generic. But at its essence, what is a bank? They take in deposits from both consumer, corporate, small businesses, and those can be short-term deposits, time deposits, and that's their funding source for loans. In addition to that, all of these banks have equity capital, and they can also borrow from a variety of sources. They can issue bonds, they can go to the Fed, They can do repos, but there's different sources of funding. But the overwhelming majority of the capitalization of a bank has historically been deposits. So for example, I talked about M&T Bank. We're a $200 billion bank. In terms of total assets, our deposits are 133 billion. So most of our assets are funded by deposits.
Okay, and when we talk about deposits, we want to understand who's doing these deposits. Is it just individual investors? Is it corporate entities and investors, and that allocation?
Yeah, I mean, that's a great point. It kind of gets to the crux of the matter of what happens in this market. So not all banks are the same. Not all banks get their deposits from the same sources. So some banks are more of a business bank. That was true of Silicon Valley Bank. That's true of Signature Bank, where most of their clients are corporations, wealthy individuals with lots of capital, lots of dollars that they're depositing with a bank, and they have a broader relationship. Other banks have more of what I would call a traditional deposit base, where it's a mix. It's a mix of heavy on the consumer, where most of those deposits are less than 250 million, which is inside the FDIC insurance limit. They also have corporate deposits, but that's not the majority of their deposit base. It's very fragmented. So we'll talk a little bit more and compare different banks and how their deposit bases were set up. And we'll talk specifically about Silicon Valley. So that's kind of the funding side. In terms of what banks do with deposits, again, they make loans. They make loans to consumers, credit card loans, mortgages, personal loans, loans to small businesses, lines of credit, lines for capital expenditures, term loans, and then corporate loans. But there's always a gap, right? So they can't fully invest all of their deposits and all their capital. So what do they do with that? Some will keep it in cash. Some will put it in the money market. And then some banks will invest in securities, both short-term and long-term. So we'll talk a little bit more about that. But just setting the stage for Silicon Valley Bank and what happened to them, you have to look back pre-pandemic, what the interest rate environment was like. So in June of 2019, the Fed funds rate was 2.4%. We hit the pandemic, the Fed intervened in a lot of ways. And what they did was they took the Fed funds rate down to 0.08%, so essentially 0%. So during that time, there was banks were looking for other things to invest in. There wasn't a lot of loan demand at the time, and there was a lot of deposits coming into banks at that point in time. There was the PPP program, so a lot of consumers were getting dollars in. They were being conservative with that money. They were putting it in deposits at banks. And then if you look at the larger corporations during this time, they weren't being aggressive doing acquisitions. They weren't being aggressive making investments in capital expenditure or working capital. So they were accumulating cash as well. So there wasn't a big demand for loans. They accumulated cash. They left the cash at banks. So the whole banking system was flush with deposits during this low interest rate environment.
And we're talking 2021. So 2021-ish.
June of 2020 was when the rates went to effectively zero.
And over the 2021 period is when you were getting a lot of deposits going into banks. People had nothing better to do with the money.
That's right.
Weren't really doing much of anything. Now comes along 2022 and the Fed starts raising rates because we have inflation that's starting to hit the market, right?
That's right. It's exactly right. So they start to see signs of inflation. They want to mute it. And so they start raising rates. So June of 22, rates are still at 0.08%. Within 1 year, by May of 2023, it was up over 5%. So a 500 basis point increase over a short period of time. And so that had a real effect across the entire banking system. And what happened? Well, the first thing that happened was depositors took their money out of banks. Banks weren't raising their rates for savings and checking and CDs fast enough. There was a really good return in the money market. You could go out there and buy treasuries or any other money market investment and make a 5% return or more. versus just leaving your money at the bank. So we saw lots of corporations do that. We saw lots of consumers do that as well.
So sorry, let me just interrupt for a second. So what we're saying is that this particular banking crisis is different in many, many ways from our 2708 banking crisis that everyone knew before. That 2708 banking crisis was really a credit issue, and that the current crisis was really an asset management issue or a risk management issue from a banking perspective.
Yes, I think, there was a systemic credit issue that kind of went through the entire financial system, both bank and non-bank alike, and we kind of saw a number of institutions fail and step in. In this situation, I think at its core, there was a long period of time, low interest rates, deposits were built up, and each bank has a different model, but they were looking to get a return. And certain banks made certain types of investments and made certain decisions. I think at the core of it, what we're going to find and what we're hearing is really it's a risk management issue. It's really a portfolio management issue. There was an entire mismatch between short-term deposits that can leave at any point in time in the system. You can take your money out of the bank anytime you want. There's no prepayment fee. There's no delay. When you want it, you can get it. And the problem is that what did certain banks invest in? So that kind of brings us to really talking a little bit more about specifically Silicon Valley Bank. So as I said, Silicon Valley Bank at the time was the 16th largest bank in the country. So over 200 billion in assets. They have a client base that is heavily focused on the business community, specifically private equity firms, venture capital firms, law firms. And again, being in Silicon Valley, a lot of high net worth individuals with billions. And so their business model was they're going to work with the venture capital firms, the private equity firms, the wealthy individuals, and provide them banking services. And those clients would then leave their deposits at Silicon Valley Bank. So if you really looked at their deposit base versus the majority of the banks in the US system, the overwhelming majority, like almost 100% of their deposit base, was in excess of that FDIC insurance limit. So that's something to think about, right? So they had a high deposit base, very chunky. And so what they saw happen as rates started to go up, people moved money out. They decided to invest it in alternative investments in money market. They also saw their corporate clients start to use their cash balances, as we talked about a little bit before. Most of these companies had accumulated cash throughout the pandemic. They were now starting to grow again. They were growing payroll. They were using money to make acquisitions. So those deposits were leaving Silicon Valley. So
Silicon Valley, though, they're smart people. They should have had hedges in place. What made them not deal with that risk management issue? If the majority of the clients were leaving or were taking money out and they saw that and they invested in loans that were longer term, wouldn't it have been prudent to have some kind of hedges in place that you could liquefy some of those assets?
Well, this is the risk management issue that we talked about, is most banks have a portfolio theory where they don't go overweight in any typical loan category or bond category. What Silicon Valley did is they made a decision to go long in securities, long in bonds. So about a $200 billion bank had a $91 billion bond portfolio. And not to get too into the weeds, but there's two ways banks can account for those securities portfolios. One is a hold to maturity, which is what Silicon Valley did. They said they're going to hold all of these bonds until their maturity, but we'll just let them roll off. And if you have them as a hold to maturity, you don't have to mark those bonds to market. So as we saw the rates going up pretty dramatically, the 500 basis points we talked about before, that portfolio, interest rates go up, bond values go down, but Silicon Valley didn't have to disclose that to anybody. Now, an analyst, you could pull their portfolio apart and start doing the math, but nobody was really digging into that deeply. If they had had it as a held for sale, they would have been taking marks every time the Fed increased rates. And so that you would have been seeing the value of that portfolio go down.
Okay. So the part of the issue, and I want to make sure we get to as many questions as we can, part of the issue is the fact also that we had a very high, as you said, 500 basis point change in the interest rate in a very short period of time. And that led to some of the issues with Silicon Valley. And the collapse of the banks mentioned has caused considerable fear in the general population. So you talked a little bit about the $250,000 a limit. For those people that aren't in the industry or that are retired, can you discuss the issue and how it relates to the crisis in terms of that $250,000 allocation?
Yeah, and again, what we saw with Silicon Valley was big deposits left quickly, sold bonds at a loss. So what happened there was all of a sudden everybody saw that they had wiped out their effectively their equity because they sold at a loss. So in the market, what happened is customers obviously of Silicon Valley, and again, the majority of their customers were not in that insured bucket. They started taking their money out. And that's when the regulators had to step in and kind of facilitate a sale to First Citizens, because there was no way to stop it. There was a crisis of confidence. And so that happened very quickly. I think what ended up happening, and there's a great chart out there where the market pretty quickly started looking at all the major banks, the top 50 banks in the US, and they looked at two things. They looked at what percentage of their deposits is within that FDIC insurance limit. And the ones that had a high percentage of their deposits, like JP Morgan, M&T, PNC, the majority of their depositors are within that insurance limit. So that created confidence. You weren't worried that your bank was going to go under. And if it did, you were insured. So there wasn't the run on deposits that you saw at other banks, where Signature Bank, for example, very high percentage of their deposits were well over almost 100% of their deposit base. So again, a very institutional business banking model that was chasing growth, which was what Silicon Valley was doing. So I think most people, and again, there was an awful lot of turmoil in March, but I think most corporations and most individuals started looking at their banks. Anyone who had dollars that were in excess of the FDIC limit were moving those dollars around. And I think that's why you saw during that March, April, May time period, there was an awful lot of discussion about banks' deposits. Where are they going? Are they going down? And I do think there was a lot of movement of deposits into the perceived larger, stronger banks that had solid capital ratios, diverse portfolios. And the other part of the portfolio that the market started looking at was what banks had a high percentage of their investments in bonds, and how had they marked them to market or not. And the banks that had the highest percentage of unrealized losses were the ones that were getting penalized, both in the equity markets as well as with the deposit base that was deciding to leave those banks.
Okay, so if I'm a business owner or a CFO of a company, how are those people now going to look at their banking partners? Are the banks going to be there for them to fund their loans, their daily operations, et cetera?
It's really topical. And, as I said before, I've been in debt capital markets where you're facilitating the sale of loans amongst banks for corporate borrowers. And we are having more conversation than ever with our corporate clients, the owners of these small businesses and larger corporations, because people want to understand who their counterparties are now. They want to know if you're going to put a bank group together, and if you're going to be a lender of mine, that you're going to be there when I need you, that you're not going to go under and have to be sold to another bank that I don't know. So we're spending a lot more time, and I think people are asking a lot more questions about what's the bank's strategy? Are you overweight certain things that could impact the future of your business? Especially when, these events typically that happen, people don't predict them very well. If we go back to the great financial crisis, that surprised a lot of folks. Nobody predicted a pandemic. That surprised a lot of folks. I don't think many companies and many banks had financial models that were predicting rates going from 0 to 5% within a year. So these are all the things from these lessons learned that both banks and small business owners and consumers are now thinking about when they look at who our banking partner is.
So do you think that the anxieties that have been created could lead to the collapse of more regional, small and medium-sized banks? Should people feel safer instead going to a larger entity or stay where they are?
I think you have to look at each bank. Certainly if you're within that FDIC limit, you should feel good. I think that the regulators effectively guaranteed every deposit in the sale of First Republic, Signature, and Silicon Valley Bank. I don't think they want to do that going forward. So I think they're going to be putting in, guardrails to make sure that these things don't happen. I think there's going to be a lot of rigor from the regulators and in the financial system in general to make sure that they understand from a risk management perspective what each of these banks are doing. There is a lot of press out there about what other portfolios could create problems for banks, large, medium, and small. And so the first one that everybody saw was the fixed income bond market because rates went up. Because we are heading towards a recession, I think regulators and investors are looking at loan portfolios, trying to understand where there could be risk there. And in an area that gets an awful lot of scrutiny, both from the investor community and the regulators, is commercial real estate. So those are big portfolios at most banks, small, medium, and large. We know what some of the issues have been in both hospitality, commercial real estate, et cetera. And so banks that have an overweight position in commercial real estate, especially when those loans may be maturing relatively soon, they may not be able to be refinanced. So I think those are some of the leading indicators that investors and regulators are looking at in the banking system right now.
All right, so how about bigger banks, though? Are bigger banks becoming too big, in your opinion?
Yeah, I don't know that I have a dog in that fight. I mean, I think there needs to be banks of size. As I said, I mean, you've got some very, very big banks and some very big well-run banks and some very big not so well-run banks. But I think what they've shown, and I think a little bit of this is due to the scrutiny that was created from the great financial crisis in the early 2000s, they have, I think, much better modeling, risk management, portfolio management, reporting, stress test, all of those things that these large banks, let's call it 250 billion and up or 200 billion and up, have to go through. So there's an awful lot of scrutiny. And I think that's why banks like, JP Morgan, PNC, Truist have been resilient through this process.
Okay, so continuing a little bit about the high interest rates, do you think they're likely to lead to other issues in the banking industry?
Yeah, I think if they're sustained high interest rates, what I think we're seeing here is an impact to the consumer. So, I think the market, if you look at some Fed surveys, and there's been some really good articles in the Wall Street Journal about following the money, what you're seeing on the consumer side, you're seeing increased auto delinquencies, you're seeing increased credit card delinquencies, rates are going up. People's salaries aren't going to keep going up, so it's harder for them to service their debt. Mortgage rates are higher, so there's less dollars to go around. I think on the corporate side, commercial real estate, if they have floating rate debt, which most of it is from banks and they didn't hedge that, they have higher debt service, and their rent rolls are down because there's increased vacancies. So that's a bit of an issue. And I think just looking at normal corporations, companies that were borrowing at 200 basis points a year ago are now borrowing at 7 or 8%. So that's a big increase in their debt service. So what are they doing? They're pruning back on hiring. They're starting to slow down their capital expenditures. They may not be doing the discretionary things. They're taking more of a conservative view. And I think that these are the signs of, could a recession be coming in the near term? Certainly the inverted yield curve indicates that expectation.
Well, hopefully the Federal Reserve will slow down a little bit on their raise in interest rates and get a little bit off the gas pedal. Is there research about which banks are too over leveraged, and how do regulators now look at leverage?
Yeah, I think how they look at leverage, I mean, the big thing is the construction of the overall balance sheet. Certainly the big equity number that everybody looks at from a regulatory perspective is, common tier one equity, which is really your common stock, your retained earnings, comprehensive income. That's supposed to be the big cushion for losses. And so, I think what regulators are looking at, and I talked about it a little bit before, is what percentage of your equity are these, fixed income securities? And if you had to sell them at a loss, how does that impact your common equity base? So I think that's, all banks are leveraged by definition. They have a very small equity base, but if they're well run, they have a diversified portfolio. They should be able to withstand, losses, and they should be able to fund deposit inflows and outflows in particular.
And I think it's interesting when we talk about this crisis versus previous ones. There's not a lot of daily short positions on banks. I mean, on any individual banks, although the overall index probably is coming down for banks. Banking stocks have declined, but you don't see individual banks themselves taking a huge hit individually. Nobody's like you did with Signature or the others. So, hopefully this is an issue that's a market-wide issue, and if we can address some of the issues, we'll get that under control. Do you think social media caused more widespread panic as withdrawals increased with the unprecedented rates, as news and Twitter, etc., made it sound awful?
Sure. I mean, look, if you go back to the movie A Wonderful Life, when there was the run on the bank there, it was everybody in the neighborhood got concerned and they lined up at the bank to get their money. It was word of mouth. Here in this day and age, it's accelerated. I think what happened was it took the market and the individual, both the consumer and the corporate and the small business, to understand not every bank is built the same way, right? So the ones that got in trouble were the ones that were heavily focused on businesses. They had large, chunky deposit bases. And so initially there was, and I think social media played a bit of a hand in this, is that everybody assumed everyone had the same problem, and that wasn't the case. So it took a little bit of time to sort that through. And I think that was one of the Fed's objectives, was they wanted to slow the run on not just individual banks, but on the banking system. And I think if you kind of read through the press, a lot of banks, especially ones that were viewed as at risk, were giving regular updates on deposit trends, right? So, and it was pretty clear that after a while, the market settled down. People felt good about what the regulators did as it relates to Silicon Valley, Signature, and First Republic. There was a confidence that was rebuilt in the system. And, again, I think we have seen kind of a steadiness in the deposit base at this point in time.
Yeah, that's a really good point, that all banks are not the same. And even the ones that failed were different in and amongst themselves. But every bank isn't an A+ bank. And, we need to realize that. Are there ripples, do you think, that are emerging in the rest of the banking community with tightening of the lending that's going to go on, or that is going on?
I think since this has all happened, I think it's accelerated what was already starting to go on in the market, which is banks are kind of taking a little bit more of a conservative approach on credit. So if you look at what's happening now, it's going to cost you more money to borrow. Banks are requiring more covenants. They're requiring more equity in deals. They want less leverage. And they're being a little bit more prudent. I think right now what you're seeing is up until this point, banks were trying to grow, and some banks were trying to grow very aggressively. I think right now in this environment, post-crisis until rates start coming down. And I think there's also some questions from banks about what additional regulations may come into play. They're taking a very steady approach. So I think we're seeing a bit of starting to see the beginnings of a credit crunch. And I think if you're an individual or a small business or a large business, you may say to yourself, now is not the right time to pursue a new loan. It may not be advantageous for me to refinance right now. I may wait and let the market kind of work itself through this part of the crisis, and then, the recession as well, potential recession.
So with that, what factors do you think will help contribute to the ongoing health of the banking sector?
I think what's going to contribute it's really just sound fundamental banking. It's getting back to making sure, and I think we've seen this historically over the decades, is the ones that pursue growth for growth's sake are the banks that get into trouble. So I think there's going to be increased rigor from the investor community and the regulators around business policies, procedures, strategies, risk management. I think there's going to be more stress testing. So those are the things I think we'll start to see a little bit more in the marketplace.
Well, and from an investor point of view, where's the growth then going to come from out of banks out of 2023? How are those non-bank competitors going to impact that growth? And, there's a lot of talk about fintech companies, et cetera. So how are the people who are investing in these banking stocks, how are they going to make money?
I think what investors are going to look at are good institutions that are well run and weather, the cycles. Who are the banks that through repeated cycles perform well, take less losses than their peer group, and have a sound fundamental business strategy. And I think those are the banks that the investors are looking at. So what's your strategy? Are you a community bank that's focused on your community and you're dominant in those markets? Are you kind of a mixed, diversified global bank like a JP Morgan? And how are you executing your strategies? So I think it's really kind of trying to segment the market and understand what each bank's strategy is. And that from an investor perspective is going to kind of dictate. I think the other thing we're looking at too is banks are always being measured on how their equity is priced versus tangible book value. I think there was a big sell-off, and I think some investors went back in because they felt for certain institutions it's a time to buy.
All right, so let's talk a little bit about this $250,000 FDIC limit. Do you think it's antiquated? And specifically, what do companies that are institutional, like ADP or Paychex, do with limits like this when they have very big liquid asset needs?
Yeah, I mean, there's a lot of companies out there. You mentioned two, all the large, very large insurance companies, brokerages, et cetera, all have dollars with banks that are well in excess of the FDIC limit. I think those institutions have a very rigorous risk management process in terms of understanding who their counterparties are. And I'm quite sure a lot of those firms, given the crisis that we just went through, were on the phone on a regular basis with the very highest levels of some of these banks to make sure they felt like they were in good standing. And I think you saw in the press that there were a lot of corporations that decided to shrink the number of banks they had deposits with and did go to some of the larger banks because they felt like they had, frankly, a more diversified funding model to be able to handle deposits and deposits leaving. So they felt good that there'd be the liquidity at those institutions to meet any company's needs, whether it was payroll or any other reason they would need dollars there. So I think that we saw a little bit of that happen, especially with some of these very, very large companies.
All right, so do you think banks will start looking at better asset management like insurance companies do?
I think, yeah, I think this is a real lesson learned. I mean, it's a fundamental mismatch, asset liability mismatch. You have clients, consumers, corporations who want loans. They don't want them for 30 days. They want them for years, 1, 3, 5, 7 years. and you're funding most of those with deposits. And the assumption is that deposit base is going to be steady and fairly sticky. So I think, a lot of banks are going to look at funding sources and how do they supplement their deposit base, and how do they weather these storms that will happen, kind of predictive modeling. How do they make the best use of the equity base? How do they supplement deposits? How do they have kind of core capital to sustain the long-term growth objectives of the firm?
All right. And another question I wanted to get into was just talking a little bit about the convergence of the banking crisis with the debt ceiling debate that we saw go on.
Yeah, it was scary times. I mean, I think that the debt ceiling crisis, that was going to go beyond an impact in banking. That would have been a global financial crisis if that had occurred. So that would have just made a bad situation worse. But it was well beyond what it would do to kind of the banking system. It really would have been catastrophic. So, fortunately, cooler heads prevailed, and we're able to kind of move on. And I think you've seen a big rally in the markets as a result of that.
All right. So let's address some questions from our audience that may have been submitted before the webinar and or in the Q&A discussion. I have a couple here that maybe we can talk about. It's been almost 100 years since we had a major run on banks. Can this ever be solved?
It's a confidence, it's a panic. It's going to be a crisis. I think, these things will pop up, and I think regulators are going to be, again, increasingly focused, but I think they're always going to be looking at what's that black swan event that's going to cause a crisis of confidence in the banking system. So I think that we'll probably see, more rigor around modeling, stress testing, not just for the very largest banks in the US, but some of the smaller ones as well.
Okay, and what should a small company do, would you suggest? You're a small company or you're an individual. The community bank is something that you want to have an association with, you want to have a relationship with. Should they consider staying with smaller community-based regional banks, or should they move their money into larger institutions?
Yeah, it's an individual decision. I think, as we talked about before, there's 4,000 banks in the US, or financial institutions in the US, and they're not all the same. They're all run a little bit differently, but, community banks, small banks are vital. They're a really important part of the overall US economy, and there's a role for them, and they're critically important. But I think this event kind of is going to allow the consumer to, make thoughtful, questions about the bank they're picking. It's probably not always going to be the bank that is the closest branch, but it may be a little bit more thoughtful around that, understanding, not just that bank's location and size, but strategy. How do they fund themselves? What are they looking to do? And again, being within that FDIC limit certainly provides a level of comfort.
So we talked a little bit about the possibility of a recession, and we know that economic forecasters have been predicting a recession for several months, even prior to the start of this banking crisis. Do you think this is likely to happen, or can we be cautiously optimistic that it will be further delayed?
So from the seat that I sit in and kind of talking to others in the banking market, and again, there's been some really good analysis done in the Wall Street Journal about, following the money, but I think we're already feeling it has recession-like feelings to it. You kind of look at loan demand is down, cost of borrowing is up, increased collateral required, as I talked about. You're seeing delinquencies in certain asset classes start to creep up. So, I think there is that feeling that we're there. I don't think you juxtapose that against where we are with the equity markets and how that has rallied over the back end of into 23. It may not feel like that to everybody, but I think if you really start looking at the numbers from a fixed income banking perspective and some of the trends, it feels like it's starting. And I think the goal of the regulators is to, make sure that that is kind of a shallow, short recession if it does in fact become a recession.
Yeah, I mean, you do see consumer spending still pretty good. You do see hiring still pretty good. I know our students coming out this year had a pretty good year.
Mhm.
So maybe that's just still some pent-up demand from the pandemic that we're seeing. And as interest rates really start making it more expensive for them to do business, perhaps they will slow down on some of those hires.
No, you're absolutely right. There is a lag effect. And the question is, how long does it take for us to fully start to see the impact of a 500 basis point increase in the cost of capital?
Mhm. And any idea, I know you have no crystal ball, but do you think interest rates will go down this year?
I don't know that they'll go down. My guess, based on what I'm reading and what everybody else is seeing, is I think the hope is that it's steadies out, and that at some point in time, kind of into the following year, we start to see a decline. And I think there's a lot of modeling out there about how quickly that decline could be, but I think that's largely due to just the other macroeconomic factors out there.
I think Jerome Powell has made it pretty evident that I think they understand. They raised rates pretty quickly, and hopefully they will slow that increase down.
Mhm.
Okay, so there's no other questions. Let me just make sure there's no other questions. I'd like to thank everybody for coming, and hopefully we've all learned a little bit about the banks, the banking system, the banking crisis, and how that relates to what's going on in our economics today. Paul, do you have any final thoughts you want to leave the audience with?
No, I mean, it's been a pleasure. I think everyone should have confidence in the overall banking system. I think every time we go through one of these events, you go back to 1933, to the Russian debt crisis, to the great financial crisis. I think every time these things happen, we all learn something, both regulators, operators, individuals who have bank deposits. So, we all kind of learn something. So it's an interesting time, but no, I appreciate the opportunity. Tom, I don't know if you have anything to add.
I just want to close by first of all, thanks everybody for joining us today. My name is Tom Fithian. I'm the Executive Director of Alumni Relations here at St. Joseph's University. And I just like to remind, as we close today's session, that this will be recorded and will live on. This webinar is made available, as are all of our recordings. I think this is our 27th at this point, online at sju.edu/unlimited learning/expert series, or you can go to SJU's main webpage and go to our alumni page. I would encourage everybody to please continue to stay engaged in the variety of alumni and university programming that we have to offer. And thanks to all that generously continue to reinvest in our mission by supporting SOAR, which is the campaign for St. Joseph's University. So to close, I want to thank you, Karen and Paul, for lending your time and expertise for today's conversation. Truly, it was compelling and an educational conversation. And on a side note, we're proud that you're both part of our St. Joseph's University community. So with that, this ends our webinar. Thank you all for your time, attention, and participation. Enjoy the rest of the summer, and we hope to see you at future events. The Hawk will never die.
Thank you.
Thank you.